All right, let's talk about the market, because right now it is sending some of the most confusing signals we have seen in a long, long time. I mean, it feels strong, but at the same time, it feels incredibly vulnerable. So how in the world do you trade in a market that just can't seem to make up its mind? That is the big question we are unpacking today, and it all starts with one sentence that just captures this tension perfectly. Okay, this sentence right here, pulled straight from professional analysis, this is our launch pad. It just nails the feeling right now. We're risk on, which, means people are generally willing to buy stuff. But, and this is the key word, that willingness is fragile. It's kind of like walking on a frozen lake in the spring. Sure, it's holding you up now, but you can hear it creaking. So what does this term, fragile bullish, actually mean for you and me? I mean, it's not something you hear every day, but it is absolutely the key to understanding this entire market environment. So let's break it down. A fragile bullish bias basically means the market looks like it wants to rip higher, the setup is there, you can see it, but just beneath the surface, there's this powerful countercurrent of selling and a bunch of technical charts that just don't line up. So the really crucial point here is the high risk of false moves. Those breakouts that look like the real deal for a second and then just completely collapse. It's a trader's nightmare. And this, right here, lays out the two sides of the fight perfectly. On the one hand, you've got serious reasons to be cautious. The big money, the institutions, they're selling, key indicators look stretched to their limits, and everyday investors, they're actually leaning bearish. But then, on the other side, the market's so-called fear gauge is super low, and prices are holding strong above their long-term trend lines. It is a true tug of war.
Okay, so first, let's dig into those cracks in the foundation. Why are so many professional systems flashing these warning signs, even while the market is sitting up near its highs? Let's take a look at the evidence.
Whoa, now this is a big one. On just a single day, nearly $1.5 billion flowed out of the main S&P 500 fund from institutional players. I mean, when you see that much smart money heading for the exits that quickly, you have got to pay attention. It is a major red flag that the biggest players are starting to get defensive. And it's not just that one day either. We're seeing institutions flip to net selling in both the broad market, SPY, and in huge stocks like Tesla. The technicals are being described as stretched. You can think of that like an engine running in the red zone. Yeah, it's still moving forward, but for how much longer? And maybe the most telling thing of all, a survey of individual investors shows that 43% are bearish. That is a huge chunk of people betting on a drop. Okay, that all sounds pretty grim, right? So why isn't the market just falling apart? Well, because that's only half the story. Let's flip the coin and look at the powerful forces that are keeping the bulls in this game. This right here is probably the biggest contradiction of all. The VIX, the market's fear gauge, is just chilling out around 15. A low VIX means there's almost no fear of a crash being priced into the options market. It suggests a calm, stable environment where stocks usually do really well, and that clashes big time with the institutional selling we just talked about. This chart really shows the market's underlying structural strength. See how the current price of the S&P 500 is comfortably floating above both its 50-day and 200-day moving averages? Those are the key lines in the sand that define a long-term uptrend. As long as we're above them, the primary trend is still, officially, up. So on top of that low VIX and the strong trends, we see that while institutions might be selling in the short term, their long-term positioning is still biased towards buying. And over in the crypto space, which is a key risk indicator, options volatility is super cheap. Plus, there's this really fascinating setup in the options market where, long story short, if the market breaks higher, dealers could be forced to buy a ton of stock, which could kick off a massive self-feeding rally. Now, to really see this battle playing out in real time, we can zoom in on 3 key assets. Each one tells a part of this fragile bull story. You can think of them as different characters in the same market drama. First up, you've got SPY, the S&P 500 ETF. Let's call it the market anchor. It basically represents the entire US stock market. And right now, it is just wedged between these huge support and resistance levels. Whichever way it breaks from here is probably going to pull everything else along for the ride. Next up is Tesla, which analysts are calling the fragile amplifier. It's a high-energy, high-volatility stock that tends to just exaggerate whatever the market is doing. It's currently coiled up in what traders call a Bollinger squeeze. which is just a fancy way of saying it's in a period of really low volatility that often comes right before a huge explosive move. It's building up energy.
And finally, we have Bitcoin, the gatekeeper of risk. As a leading indicator for how much risk people are willing to take, its performance is just crucial. If Bitcoin can hold its key support levels, it sends a signal that investors still have an appetite for risk, which keeps the gate open for confidence to flow into other assets, like stocks.
So, how do we actually track all of this? Well, this table basically simplifies everything down. It shows you the critical price levels that professional systems are watching at this very moment. For SPY, a break above 650 is the bullish trigger. For Tesla, it's 355. For Bitcoin, 113.5 thousand. On the flip side, a drop below the levels in that bearish trigger column would be the signal that this fragile bull has finally broken down. These are the lines in the sand. Okay, so given all this back and forth, all this uncertainty, how do professional traders handle it? It is not about guessing. It is about having a disciplined plan. Let's take a look at the playbook they use. This playbook really boils down to 4 critical rules. Number 1, it starts with patience. You wait for the price to confirm a direction. Don't jump the gun. Once you're in, you manage your risk by limiting your exposure. Then, and this is so important, you take emotion out of the equation by using automatic stop losses to cut any losses quickly. And finally, you are always prepared for the worst with a contingency plan, like a hedge, armed and ready to go. And here's just one example of what that might look like in a real portfolio. This particular model puts 40% into the stable core, SPY, but then it diversifies with 35% in a BTC ETF for that growth potential and 25% in Tesla as that high upside amplifier play. See, it's a balanced approach to a very, very unbalanced market. You know, this quote just sums up the entire professional mindset right now. The plan is in place, the trades are ready to go, but the finger is just hovering over the button with a very, very high degree of caution. It's all about being prepared to act decisively, but only when the market gives you a crystal clear signal. And all of this leaves us with one last thought to chew on. In a market this fragile, this full of contradictions, maybe the old definitions just don't apply anymore. Maybe being bullish today isn't about blind optimism at all, but about being disciplined, being prepared, and, like the pros say, being armed and ready. Thanks for tuning in.